Welcome back to another video. So Charlie Munger is the vice chairman of Berkshire Hathaway, and he's also Warren Buffett's investing partner. In this video, we're going to do a response to an interview that he did where he talks about inflation, quantitative easing, stock market, the potential bubble we might be in, and also how politics can affect the economy. So what we're going to do is we're going to watch some of those clips here of his answers, and then I'm going to respond with a little bit more information so that by the end of this video, you'll be able to walk away feeling a little bit better prepared for the next year or decade to come in your investing journey. Let's jump in right now. So as you'll see, Charlie Munger is known for giving some relatively brief and what seem like uninterested answers, but the things that he says are really important. So just know that even though it might seem like he's uninterested, he has been around for a really long time and has a lot of great knowledge to share. So the first question he gets asked is about how governments are continuing to print money and what the effect that might have on the economy and on the world's money supply in the future.
Two different questions. What do you think of the combinations of quantitative easing and large fiscal deficit, and where are they going to lead us?
Well, there I've got a very simple answer, and that is, it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire. It's unbelievably extreme. Some European government borrowed money recently for some tiny little fraction of 1% for 100 years. Now that is weird. What kind of a lunatic would loan money to a European government for 100 years at less than 1%? It's utterly without precedent in real terms. It's unbelievable. I watched the whole damn thing practically because I've lived so long. And it's been absolutely astounding. I can remember having a 5-course filet mignon dinner in Omaha for 60 cents.
And so basically what Charlie's talking about when he says that we're playing with fire is the long-term risks of printing money and how that might lead to inflation. And so with inflation, one of the reasons it can actually be negative is that even though with inflation your wages or your salary might increase, the costs of goods actually might increase at a faster pace than your wage. So even though you might be making more, you can actually pay for less with the money that you're making because prices have actually gone up higher than your wages have gone up higher. And so that's one of the risks with printing more money, is that all of a sudden the money that we actually have on the market or in the supply is actually less valuable than the money is today. And so what Charlie's talking about is the risk of inflation if the economy does not actually match the rate that inflation is going up. That can be really bad in the long run and have a lot of long-term consequences that won't be good for your investment portfolio. Next question that Charlie gets asked is about whether the Nasdaq is in a bubble or not. Over the past year, tech stocks have seen a huge rise with prices, and a lot of people are wondering if these prices can continue to rise with future earnings or if we're in for a popping of the bubble. Let's hear what Charlie has to say.
Is the Nasdaq in a bubble, and will it blow up? And do we know when? Is the Nasdaq in a bubble?
Well, nobody knows when bubbles are going to blow up. But just because it's NASDAQ doesn't mean it'll have another run like this one very quickly again. This has been unbelievable. Again, there's never been anything quite like it. If you stop to think about it, think what Apple is worth compared to John D. Rockefeller's oil empire. It's been the most dramatic thing that's almost ever happened in the entire world history of finance.
So in Charlie's response, when he's comparing Apple to Standard Oil was actually a huge company, the largest of its time. It was valued at about, in today's dollars, $1 trillion. Apple at the moment is nearly $2.5 trillion. And just those numbers alone doesn't necessarily mean that the Nasdaq is in a bubble. So although prices have continued to go up, maybe their earnings have not actually met that rate of increase that we would need to see to maintain these valuations in the long run. And if you might think that the Nasdaq is in a bubble, it's going to be impossible to predict when it's actually going to burst. The next question that Charlie gets asked is about the returns that he is predicting for the next decade. The last decade, the last 10 years, have seen really large returns in the stock market. But the question that's asked is if he thinks those returns are going to continue or not.
you expect the next 10 years to have lower returns in the equity markets than the last 10? It doesn't give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it, and the frenzy is so great, and the systems of management, the reward systems, are so foolish that I don't think it's going to work at all. I think the returns will go down. Yes, in real terms, the returns will be lower.
So the answer that Charlie gives here is kind of related to the second question that we went over as well, where a lot of times what seems to be happening in the stock market is that the price of a stock is not solely relying on the actual value of a company. There are a lot of assumptions that are going into pricing stocks today, especially in the tech sector, and that can actually lead to a lot of volatility in the future and potentially even some lower returns once things get back to normal and start to actually have a more reasonable valuation based off of their near-term future earnings. There's a lot of focus right now, and there has been even over the last 10-20 years, on how management at companies are only compensated based off of how earnings per share grows. And a lot of times it's easy with accounting to manipulate the earnings per share in a way that shows growth, even though the actual return on assets or the return on equity of a company is not actually increasing at a similar pace. So Charlie is just mentioning that right now the rewards that management is receiving don't always correlate with the actual value that a company might be bringing or the growth that a company might be experiencing as well. And the last question is about China and how politics can affect returns in the stock market. So let's jump in and hear what he has to say.
The other thing that's really remarkable, the last 30 years of China, they have had real economic growth at a rate for 30 years that no big country has ever had before in the history of the world. And who did that? A bunch of communist Chinese. Now that is really remarkable.
So how would you rate investing in China with the current political tensions? Or are you invested in China through the ownership of American companies that do business in China?
Well, of course I'm invested partly in American companies that do business in China, including Coca-Cola. But I'm also invested very significantly in China through the management of Li Lu, whom the Munger family backed heavily when he formed a little private equity firm to invest in China. And he has had a very successful record, and that's made me follow very closely the leading companies in China.
And does that say that sort of the politics don't matter so much? Or
yeah, that's a very interesting observation. What that shows is exactly right. Who would have guessed that a bunch of communist Chinese run by one party would have the best economic record that the world has ever seen? Of course it's extreme. And I think it proves that, it doesn't. We Americans would like to think that our free expression and allowing all kinds of opinion and all kinds of criticism of the government is totally essential part of the economy. And what the Chinese have proved is you can have a screamingly successful economy with a fairly controlling government.
So the biggest takeaway here is that politics are not a direct correlator to how a stock market is going to perform. There are a lot of ways that different governments are run, but that does not always relate to how a stock or how a market or economy will perform as well. So just be aware that sometimes politics and the actual economy or the actual market are not correlated and don't always relate. I hope you enjoyed that response video to Charlie Munger. Let me know what you think in the comments. I'd love if you could like this video and subscribe to the channel. I really appreciate you being here, and I'll see you next time on Quinn Talks Money.